Well, thanks for having me, Reed. I appreciate it. Just before I get into the presentation, just a quick background, and then I can go ahead. So if you don't see the slides moving, just give it a minute here. But quick background: you may or you may not know that there's over $2 trillion invested in the hedge fund world. Very few of us, actually most of us listening, know very little about them. It is a world really exclusive to the institutions and the super wealthy. And unless you fall into one of those two categories, your ticket to access is basically unattainable. One of the reasons it is such an exclusive industry is that it truly is run by the brightest minds on Wall Street. And the funds recognized as true hedge funds, funds that are trading in excess of $1 billion, really are what we refer to as true funds, usually perform extraordinarily well. Now this in turn attracts the high-end clientele, and due to the performance, the price of entry just continues to rise. Now, to play in the space, you must fit a certain financial profile and have at the very least $1 million of liquid capital to invest. There are some funds, believe it or not, that require a net worth of $5 billion and an initial $100 million investment just to get into the door. It literally goes up to that level. Now, I've had the unique opportunity to get to know many of these wealthy clients, and I've been entrenched in this world for a lot of years. One of the main things that I've learned is that the super wealthy, they generally know what they know, but more importantly, they know what they don't know. And that includes the markets, and that includes investing. You'll virtually never see the ultra wealthy buy into hype, flashy marketing gimmicks. They don't chase a hot stock or a hot sector, or listen to self-proclaimed gurus or TV pundits. And they certainly do not attempt to expand their wealth on their own homemade trading system. The fact is that this industry, whether you believe it or not, is several steps ahead of everybody. Now, as soon as the general public hears about an opportunity, the institutions and the real hedge fund pros have usually profited and move on with their clients days or weeks earlier. Little do we know, the opportunity that we are now hearing of and are now moving on is merely the leftover fruit. Now, with the quantum approach, we are attempting to change all of that and hopefully give you some insight to the psychology of the hedge fund mind and its core investing principles. A quantum hedge fund is a quantitative system that is designed for the everyday investor. The system focuses on procuring high-level, institutional-grade hedge fund research and making it available to the newbie investor and the seasoned investor alike. Now, this top-tiered, unbiased approach studies, analyzes, and most importantly projects performance for equities within the S&P 500. Now, it detects and moves ahead of small shifts in the market, delivering precise, real-time research to you, now, generating fantastic profit potential for anyone's account, no matter how big or how small. Now, this information is every bit what the wealthiest clients and the big guys use. Now, normally access to this system is reserved for individuals who have at least $3 million of liquid capital to invest. Now, the reason quantum is now available and able to show the everyday investor what it does is that the system and its research has been scaled. It's been scaled down. And at the end of the day, after all the filtration and after all the disciplines have been met, the system averages about 1, maybe 2 trade ideas every week. And since you, the investor, maintain complete and total control of your own money and trading accounts, you are able to implement certain components of this quantitative system to your own investment processes. Again, these trade ideas are generated by a sector-leading fund's proprietary quantitative model, implementing specific algorithms that withstand several levels of filtration to ensure the most accurate research and investment education available. Now, if you do not have the financial profile or means to participate in this world, in this hedge fund world, then this is the next best thing, and it's like nothing you have ever seen. This brings us to our long-term capital growth relative value arbitrage. Now, this is a statistical arbitrage, not an academic. So we may show you the approach to taking advantage of price difference and price imbalances. My screen here, there we go. Now what we'll talk about today is the advisory highlights, the philosophy, the model, our processes, our risk management, which is very important, always seems to be a big topic with every time I've spoken. We have some historical data, some basic sample trades that we have done. So after all this, after all the nonsense is discussed, and it really just comes down to a symbol and a price, so we can show you those as well. Now the quantum philosophy, this approach focuses on the S&P 500. Now although complex in nature, the system keeps things very simple and adds all the extraordinary circumstances that affect your ability to profit. Now ultimately, your ability to profit is measured by the market participants' interpretations of price and the ongoing battle between buyers and sellers to determine what price should be. Now these interpretations are being made by the largest institutions to the smallest trader and are influenced by several variables. And those are extensive research or momentary impulse, quantitative or qualitative, brilliant or ignorant, reactionary or preemptive, emotions and feelings, logical or illogical thought, rational or irrational thought. These variables of the buy-sell decision-making fall into one quantitative metric, and that's price movement dynamic, or what we refer to as PMD. Now, by carefully analyzing the PMD, along with all its connected supply and demand traits, such as range, volatility, volume, we're able to optimize our ability to forecast price points, and with that, generate massive profits. And we can assure you that by following along today, you'll be able to replicate components of this approach immediately, and at the very least, tighten up your own investment disciplines. Now the advisory highlight that we offer, this is kind of a fast forward, is the system obviously we're going to get into and talk about the model, but what it really focuses on is the system detects equities with upside potential that will at least meet the 12% return threshold. Long and short exposures generate in all types of markets. Now this quantitative model focuses on long and short exposures with the occasional option overlay. Only S&P 500 stocks. The model adheres to its principal roots. It is not set up to chase a hot stock or hot sector or any sort of penny stock. Low correlation of the S&P 500 index, our trade frequency, again, as I spoke just briefly beforehand, about 1 to 2 trade alerts per week. It is not designed for day trading or quick turnarounds. However, we have had turnarounds within a week, so it's not necessarily super long term, but it's definitely not in and out in a day. Well over 10 years of research and development led to the launch of this proprietary model, along with 45 years of extensive backtesting with over 500 positions, over 550 months, and 275,000 data points. The Quantum Advisory is designed to further the market knowledge and education of our members through detailed market research analysis. Many of the principles that we will discuss today are staples in our core trading philosophy. And many of these concepts you'll be able to implement into your own investment processes today. Now the model. Quantum employs a proprietary quantitative model and systematic research process in a long-short equity framework. Quantitative model, for those that are unaware, is simply a model constructed to measure. In this case, we've constructed this model to measure the S&P 500. Now, this quantitative model ranks the S&P 500 for internal measures of behavioral strength and consistency. Now, the long portion of the research is constructed by analyzing a basket of the highest ranked equities in the S&P 500. So from 1 to 500, the highest ranked. The short position of the research is constructed by selling short a variable size basket of equities that display the fastest drop in rank. In other words, the system detects the fastest rising and the fastest falling equities in this structured framework in real time. Now, based on this data, the construction of the portfolio takes shape. The system measures to 1/100th of a penny in lightning fast speeds, and the rankings and shuffling is in constant motion. Now, the systematic process utilizes disciplined risk control parameters and rules for trading, individual portfolio construction, and rotation. For quantum, it looks for entry points that will give the greatest probability of achieving our minimum gains threshold, without exception. This is a discipline we adhere to regardless. And this is something that we believe you can easily implement into your processes. Now, trading methodologies include predefined entry and exit and stop loss rules. Now, individual portfolio construction and rotation employ behavioral finance concepts as risk overlays. The system constructs the positions by employing the rankings or the behavior of each equity. And based on that, the equities are being rotated and or properly entered or exited. Now, the quantitative process or the measuring process. Concepts which the model employs to determine rank, our rank from 1 to 500, include: we measure money flow, volume, trading range, trading consensus, high-low divergence, and relative relevance. Each concept you see here has been given a specific value, which then is implemented into the algorithmic model. I'm not sure if you use any of these concepts to help you with your investing, with your own investing process, but if not, these are things we believe will help, especially once you commit to continually analyzing them. Now, the key unifying components of the measuring process include time cycles. Time scales vary across ranking criteria. Weightings. The parameters adjust as a function of market cycles. And data points. High, low, open, close, volume. Pretty self-explanatory. Basically, what we are saying here is based on equities' rise or fall in rank, the system utilizes time cycles and data points to properly gauge those equities' behaviors and then weights them accordingly. For example, a recent equity was Gilead Sciences. Now, if Gilead Sciences has consistently been a high-ranking equity in the model but yet shows an uncharacteristic drop in rank, an exit is not necessarily inevitable. Whereas another equity that has been in and out of the higher ranks and shows signs of inconsistency may be flagged, repositioned, and or exited. Brings us to our models, indicators, and algorithm. The following are 3 of the 12 indicators utilized by the model. Price-adjusted volume. A commitment study that analyzes the increase in volume relative to the increase in price over a time period. This analysis gives an indication of the desire to own a particular stock regardless of price fluctuations. For example, let's just use ABC Corp. ABC trades at $50 on January 1st, 2012, with an average daily volume of 100,000 shares. On January 1st, 2013, ABC trades at $100 with an average daily volume of 100,000. The capital, price times volume, traded on the stock went from 5 million to 10 million a day. This indicates that the market participants are just as committed to this company at the new price than they were before, indicating more demand for the stock. Most traders would only look at volume, missing an important piece of this information. The money flow, an intention study that analyzes the volume on a positive price move versus the volume on a negative price move. When equities rise on high volume and decline on low volume, it indicates that there is an underlying intent to accumulate stock without moving the price. That's strategic buying. For example, our ABC Corp. ABC went up Monday on 120,000 shares, down Tuesday on 78,000 shares, down Wednesday on 56,000 shares, and up Thursday on 113,000 shares. ABC moved in a positive direction on 233,000 shares and in a negative direction on 134,000. The ratio of up volume over down volume gives a metric that helps evaluate the behavior of a stock relative to its peers. This brings us to the third indicator of close on range. An eagerness study that determines when an equity closes on its range, whereas the intraday activity is a fight between buyer and seller. The closing price identifies that winner. Now, by identifying the winner's position relative to the range, one can introduce investors' eagerness. Closer to the high, eagerness to buy, and closer to the low, eagerness to sell. So, for example, what we're saying is ABC Corp fluctuates between 39 and 41 throughout the day. 39 being the low, 41 being the high. If the stock closes at $40.50, it has closed 25% off the top of its range. When on average, an equity consistently closes when an equity consistently closes so closely to its high, it is a sign that accumulation is occurring. In simple terms, if someone really wants to buy, if someone really wants a product, they will go out and buy it immediately, not wait for a sale. People are very eager to buy Apple products, for example. Now, while each indicator has been independently tested for predictive value, the model dynamically combines all 12. 3 other additional indicators that are not shown here that I think are important for people listening to know are time frame volume, high-low divergence, and range expansion and contraction. Time frame volume, which is the first one I mentioned, really measures the degree to which buyers and sellers are traders, and it measures the degree to which buyers and sellers are traders versus investors. So buyers and sellers being traders for the short term versus investors, which make up the long term. Time frame volume measures that degree. Now, high-low divergence really aims to determine the degree of excitement that exists around a stock, and our range expansion contraction, which analyzes the changing range over time. So those are three additional indicators. Now, the mythology. Based on behavioral finance concepts, this disciplined approach replaces emotional reactions with objective quantitative analysis, ensuring that human emotions do not cloud timing, trading, and capital decisions. In other words, a decision is never, ever made on a gut feeling. Hairs standing up on the back of your neck, or a little angel sitting on your shoulder. The prospect theory, now this outlines mistaken psychological inclination to hold losing positions while eagerly selling winning ones. That is not quantitative. That is purely a human emotion. We show our members, and we show you how to hold winning positions for the long term versus the quick liquidation of failing positions. The model is designed to maximize gains and mitigate the risk. Our sunken bias demonstrates the average person's affinity towards certain sectors or companies based on past events that encourage excess weightings or holdings. Now, we rotate and rebalance the portfolio regularly, establishing equal weighted positions in those that best fit our criteria. Now, many traders fall in love with certain sectors, say pharmaceuticals, for example, because they've had success in these sectors, or they feel they know more about them. Now, it's critical that you weight and balance your portfolio properly. Every big reputable fund adheres to this simple rule. The cognitive bias. Now, this illustrates the tendency of well-informed individuals to consistently do the wrong thing due to under-analysis. Now, we mitigate this risk by relying on extensive research and our disciplined ranking and trading guidelines, and the avoidance of panic selling or buying into exuberance, which happens all too often with others. Now, this behavioral finance concept is a large reason why the everyday trader is at a distinct disadvantage. Some of this seems basic in nature. However, investing as a whole is basic in nature, and so is the psychology. It's when you go several levels deeper into the psychology is when you can see things that others don't and develop an advantage. Now, we have values for the numerical values for the psychological as well, for the psychological component as well, and our model reflects those numerical values. This brings us to our risk portion, which has three distinct components, which is market risk, account risk, and trade risk. Now, we seek to educate you on how to minimize daily volatility, monthly drawdowns during times of market staggering or major market movements. I'm sure you guys can remember last mid-October. It was a pretty crazy time. During this time, based on our disciplines and filtration, our system was up, and it was up quite substantially. I wouldn't be surprised if we were one of the only funds that was up in the country during that time during mid-October of 2014. The employment of a stop-loss methodology in the weekly synopsis is given. Now, based on ranking criteria, we give specific stop-loss parameters. Some have tighter ranges than others, but they are always there. We adjust of long-short exposure utilizing broad market trends and behavior. Now, as market conditions change, so does our long-short positions. In fact, we are predominantly long, but could easily flip those long-short ratios. Discipline rules identify conditions to increase and decrease short percentage. Now, if our model shows an equity to enter at $55, but yet that equity slips to $45, long-term values usually show to cost average down based on strict disciplines that are always followed. In other words, we believe in the equities, the system delivers. Portfolio rebalancing to offset natural position variance, which is market exposure, long, short, spread balance, position weighting. Normally, with the quantum scaled version, we like to hold about 12 positions, 8 long, 4 short. But as conditions change, we could reweight those positions to 8 short and 4 long, or any other variation. The system, the model, is highly adaptable. And we do continuous scenario analysis, which facilitates refinement and optimization of the risk management techniques. Which brings us to the account risk. Sensitivity to position beta aims to dampen the research volatility. Appropriate diversification minimizes risk, minimizes the basis risk. We rebalance so the portfolio is representing different sectors. Adherence to disciplined use of stop losses and price objectives per position, using event stop, price stops, trailing profit points. Percentage thresholds are based upon both quantitative trigger points and qualitative reevaluation scenarios. As our equities climb, profit points are automatically implemented to mitigate risk, and this is something the everyday trader should implement and could implement immediately. The systematic volatility stops. 2% drawdown in our model triggers comprehensive monitoring and analysis. A 4% drawdown triggers an in-depth portfolio review and liquidation of the weakest positions. Now, a 2% drawdown automatically triggers analysis of that equity. Depending on rank and historical behaviors, that equity may be exited, especially if this drawdown has taken place in an equity that has recently risen into the top of the rankings, if it has recently risen. Now, these type equities do not have the historical behavior, rank, or model value to hold a long-term position in. However, a long-standing equity with high rank characteristics that have been in the high ranks for quite a while will be held unless it reaches the 4% drawdown mark, which then, and only then, will trigger a portfolio and position review and could result in liquidation of the weaker positions. That could absolutely take place. And that leads us to our third component of risk management, which is our trade risk. Disciplined trading methodologies and risk control measures seek to minimize potential drawdowns and position volatility. Volatility bands are utilized to determine technical low risk entry points where risk-reward probabilities are highest. Volatility bands, they're just indicators that allow for volatility and price levels to be compared over time. And we do this so we can quantify price action. Now, entry and exit parameters are optimized in hopes to maximize our objective return versus stop loss ratios, which is above 3 to 1. Risk overlays seek to mitigate basis risk, such as significant news events or company catalysts that may adversely affect our expected return. This could be rumors. This could be an earning announcement, for example. Now, an equity option overlay may be shown to provide an additional hedge by capturing a return on equity's specific volatility, as well as mitigating gap risk. We may implement an option strategy around a company's earning announcements, for example. Now, qualitative research aims to identify information that may not be reflected in historical price data. This qualitative research is also placed with a numerical value for our model. Now, this allows for qualitative change, especially in the quantum portfolio and the quantum curriculum. Now, trading the S&P 500 equities ensures liquidity and transparency, so it's all right there in front of you. Which brings us to the conclusive research, deals with some of our backtesting. The average monthly return of the highest ranked selection since 1967, which is the first year, I think, shows the S&P was actually recorded, more than double, which is actually 2.5 times the average monthly returns of the S&P 500 over the exact same period. Now, research demonstrates a powerful association between rank and future return. A rank return regression of 500 positions with over 550 months and over 275,000 data points demonstrates a powerful statistical arbitrage between the highest ranked selections and the S&P 500. And we utilize robust backtesting methodologies with multiple blind studies which eliminated curve fitting. 45 years of market data ensured a wide gamut of market conditions, basically every condition. We account for carefully for potential selection and sample biases, including survivorship bias, attribute bias, and look-ahead bias. That brings us to our advisory characteristics, some of the stuff that we've discussed, kind of a brief summary of the number of targeted positions. Again, we look to hold 12 in this scaled version. As we discussed, we seek to hold 12 positions, and this system is not identifying 50 different equities at once. It is not day trading. We refer to this scaled version for the everyday investor as chess and not checkers. Only the S&P 500 equities are published, full scalability, no capacity restraints, no leverage on the long side, maximum per dollar of equity, minimum per dollar, and no subject to margin interest. Minimum monthly alerts limits trading cost and slippage. Winning positions aim to be held long-term to achieve long-term capital gains treatment. Now, this is based on behavioral science we covered in some of the former slides. Losing positions are shown to be liquidated quickly via our stop-loss rules and our risk management factors that we discussed. Differentiating factors. A fully proprietary quantitative process. A novel and exclusive ranking system. Provides sustainable arbitrage and robust risk-return profiles. It's tested and optimized trading and risk control rules. This refers back to over 45 years of backtesting and over 500 positions and 275,000 data points. Unique combination of risk management techniques, stop-loss procedures limit our monthly drawdowns and volatility. Ongoing research, simulation, and development. That's something that will never change. An adaptable model offers the ability to perform in changing markets. And this is important because the market changes day to day. And our model changes second to second in terms of the rankings. And the pursuit of mean expansion versus reversion. Which brings us to a historical performance chart, again dating back to 1967, which is the first year the S&P is recorded. it shows that if there was $1 invested in the S&P and $1 invested in quantum, this would be the price imbalance, the price difference. Now, after all of, again, the technical, and after all the mumbo and jumbo, and after all the filtrations and disciplines, and as these names or symbols kind of meander through the system and finally make it to the desk, these are the symbols that, here's an example of a trade that we did. This was actually recently, closed it out last month, or December, 20% gain. Here's another example, pharmaceutical trade. We give a full synopsis to our members showing exactly why Alexion Pharmaceuticals was selected, with target points of entry, target points of exit, stop loss instructions, and again, a massive gain of 44% in about a 60-day time period. So these are just two basic examples of our trades. Here is a snapshot of trades that we've done. This is ending about a year ago, February. We will be releasing 2014, a portion of the 2014 numbers here shortly, but you can see just how precise the system is. Extremely good year. This seems to be very similar to 2012, 11, dating back. Let's see, we only have about 5 minutes here, a few minutes, two or 3 minutes here. Let me give you guys the I can get the. There's a. I just posted our URL. We do have an advisory, as we've been talking about throughout this entire presentation, where we do bring on members, individuals that have smaller accounts, people that don't meet the $3 million liquid capital threshold, to where they can literally stand shoulder to shoulder with us and do the exact same trade strategies and trade ideas every week. It's about one trade a week we publish to our members, showing them exactly what to do. We have a full trading staff that has been set aside for our members, and this is like something that really there's nothing out there like it. I think we might be the only organization that actually does this. Anyway, that is basically the presentation. I hope I didn't go too quickly. I know it was a lot to cover. Let me see if there's. You can go to we have our 800 number here, 866-828-2266. Again, our URLs I just posted, and that would be it. Any questions or?
Yeah, you have a couple minutes, about 2 minutes, if you want to take some questions.
A couple minutes? Okay. Yeah. I'm just looking here to see. Okay. The minimum investment actually for there's no investment. You're not necessarily investing in quantum. It's more of an advisory. You control your own account. You are not investing into the fund. The advisory is actually set up to where we actually will publish our trade ideas every week. We do about 1 or 2 a week. It's very limited but precisely accurate. So you'll be managing your own account, whether it be your E-Trade, Ameritrade, or whatever platform you're using, and you can follow along and basically do the exact same strategies that the fund is doing. Thank you, Rick. I got appreciate the compliment. Hope I didn't put you guys to sleep. Let's see here. Anything else? Dave asked, do I execute the trades? No, you execute the trades. Again, we deliver the trades after the market is closed. So after you get home, your day's closing down, you can check your email. You'll have your own login credentials to the website, which you can access 24/7. It gives you full access to the entire trading table. And then you can go in and if there is a trade, it will be emailed to you. And then you can go ahead and execute the order yourself using the platform that you're using. I get a few questions about the cost. What the cost is we are actually doing it's $1,997 initiation, and then that's to get you full access, your login credentials to the entire trading table, and then it's $197 per month after that, and you can cancel at any time. I guess that's the way we have set this up. This guy went to sleep. Does Quantum have any prior positions in stocks they are recommending? Yes, we are. We have a full portfolio for our members right now. We've got about 11 positions that are open that are members only. These are what are filtering down to Quantum. These are the scaled version that we are publishing on our website for our members. So yes, it is happening as we speak. Yes, it is being recorded. Can you provide the website? Yeah, I posted that here, but it's quantumhf.com/sales. I thought I posted that here. I'm not quite sure how to. I've only presented on GoToWebinar once or twice, but /sales-page.html. So that's quantumhf.com/sales-page.html.